you've got questions, we've got answers. We have the man to answer them. Jeffrey Levine from Buckingham, both partners. Jeffrey, welcome back to another episode of Ask the Hammer.
Hey, good to be back. That's me.
It's good to have you back. And I've got several questions in my inbox, one of which goes like this. Given President Biden's proposed changes to the capital gains rate, should I consider selling the assets in my portfolio, especially those with substantial capital gains?
Well, Bob, that's a really timely and important question because I do think we're likely to have a much different capital gains regime, at least on the upper income end of the spectrum next year than we do right now. Notably, right now, long-term capital gains are taxed at a maximum of 20%. Now, you do add the 3.8% surtax, but next year under the Biden plan, to the extent that an individual had more than $1 million of income, the gains attributable to that income in excess of $1 million would be taxed at ordinary rates, which under the Biden plan is 39.6% plus the 3.8% surtax. So effectively doubling the rate that applies to those gains now. Now, interestingly enough, as I mentioned, this only applies to individuals with income in excess of $1 million, but the people who are impacted aren't just those with AGI or annual income of $1 million or more every year. Instead, think of the people who once in a lifetime maybe may have an income event that brings their income north of $1 million. Specifically, how about someone who owns a sizable piece of real estate? They've been depreciating, so reducing the basis, and now it is appreciated in value. They may very well have a scenario where they have more than $1 million of gain when they sell that piece of real estate. How about a business owner who spent the last 40 years building up their business? Maybe they make a very nice and comfortable living of $200,000, $250,000 a year, but nowhere near $1 million. But what happens, Bob, when they go to sell that business? That business may generate $2 million of sale of gross proceeds. They may not have a lot of basis in the business. That may push their income artificially over. Or under the Biden tax plan, death becomes a realization event and there's no step up in basis. So effectively, you die and we treat as though everything you own was sold in one fell swoop. Not even if it's not sold, we treat it that way. Well, that could push somebody over $1 million on their final income tax return. And so those are all individuals who may consider selling now in 2021 prior to the imposition of these likely future changes. Now, ultimately, this is still just proposal, so it's not set in stone yet. And look, maybe they decide to do this, but it's not 1 million, it's 2 million or 5 million or 10 million, who knows? But the problem here is that while if you have stock or mutual funds or ETFs in account on December 31st, if this law got passed December 30th, you can kind of push a button and sell those and capture those gains today at 20%. But if you're looking at selling a business, if you're looking at selling a piece of real estate or other types of illiquid investments, these aren't things where you just, as I said, snap your finger and they're gone. They take time to price. They take time to look for a buyer. There's due diligence that may have to happen, either on a business or inspections that happen on real estate. These all take time. So if you even want to give yourself an opportunity to have the chance to sell, you may need to start taking action now. And of course, it's worth noting, too, that there are potential changes to the estate and gift tax regime on the forefront as well, which may necessitate or at least indicate a need or desire to shift assets outside of your estate. And some assets may be better off not being shifted. You may be better off with cash or other things and perhaps a business. So there are various things to consider here. Every situation is different, but it is absolutely something that those at the higher income end of the spectrum, or those who could, if they have a future, again, one time or few time, limited time sale of assets, see themselves pushed over that $1 million mark, the time to act may indeed be 2021.
Yeah. So that I suppose in terms of action steps, talking to your CPA and having them do some what if scenario planning is among the things that you might consider doing.
Yeah, certainly your CPA, your financial advisor, some other professional would be good to reach out to at this point. And then understanding kind of where you are in that spectrum. Look, maybe you are someone who will never get there in gains. You could have, like a lot of people, saved the majority of your assets inside retirement accounts. So you don't have a lot of gain. Maybe you own a house that's $400,000 house, and you have $100,000 in a brokerage account because you've got $1 million in your IRA or your 401k. That's where you've done most of your savings. Not really something you have to worry about, even though you're doing pretty darn well. On the other hand, if you've got some sort of asset that is highly appreciated, whether that be a stock, a business, a piece of real estate, and you are likely to sell it in the near future, right? If you're thinking, gee, I was thinking about selling my business in the next year or two, or selling this piece of real estate. Well, you're a prime candidate for accelerating the sale of that asset now into this year. Because the last thing I want to do is sell a really expensive piece of real estate or a big business or a big stock gain on January 1st of next year, right? I don't want to do that. I want to move it back one day to December 31st this year and pay half the price in terms of taxes. And if you're someone who's looking at an appreciated asset, but wasn't looking necessarily to sell that until, 5, 6, 10 years down the road, you're in a tougher position because either you give up the income or future appreciation you were banking on for that asset and get a lower tax rate, or you count on getting that income or appreciation in the future. But when you do go to sell it, you're stuck with a much higher tax bill.
Yeah, it's a conundrum, I think, and I know you're fond of saying things like, don't let the tax tail wag the investment dog, but this is a case where you have to, in a way.
You have to make informed. Look, it's about how much you have to keep or how much you get to keep, not how much you have to start with. And so there's a lot of business owners out there or people who own real estate or stock who may find themselves spending the next 3 years seeing an asset grow only to end up netting still less money than they would today after taxes if they sold it. So focus on net after tax value. The reason we always say don't let the tax tag wag the investment dog is because sometimes people are so worried about taxes, they miss out on bigger gains that even after taxes are better, they're better off. Here, we're talking about a scenario where the difference in tax rate could be so significant, again, basically double the tax rate, that paying tax now and taking a little bit less on the investment side afterwards may in fact be the net win. Got to look at it individually, but we've got a lot to talk about over the rest of this year and beyond.
Yeah, so I know you and I have joked about all these proposals and possible laws being job security for journalists and CPAs, but this is another case of job security, I'm afraid.
Yes, Ask the Hammer will have many seasons to come.
All right, well, you answered that reader's question, and I'm sure it was a question on the part of many other readers as well. So,
we could not be happier to have those questions. With new tax laws on the horizon, we want to know what's on your mind. What do you want to know about? You got a question? Give us an email. Give us a shout. Email us here at askthehammer@buckinghamgroup.com. Again, askthehammer@buckinghamgroup.com. And Bob and I look forward to answering your questions here real soon.